guys, it's Stock Curry. I've got over 20 years of experience trading stocks, and in today's video, we're going to talk about the Fed raising interest rates, the Russia-Ukraine conflict, oil prices, and the earnings coming up this week. So let's get into it! When it comes to the Fed raising interest rates, it's important to remember that the number of rate hikes really doesn't matter. What's important is how much rates are hiked. CME futures are pricing in a 50% chance of a 0.25 basis point rate hike in March and a 50% chance of a 0.5% basis rate hike in March. Now, in addition to raising interest rates, the Fed is also in the process of finishing up their tapering, which means they're still printing money right now. Bond buying is scheduled to end on March 10th, the same day the February CPI inflation numbers come out, and just 5 days before the Fed March meeting. That means the Fed might announce the selling of their bond assets at the March meeting in addition to raising interest rates. If the Fed decides to start selling their bond assets, that could cause further downward pressure on the stock market because that is not yet priced in. Also, keep in mind that the Fed's January meeting minutes are being released on Wednesday this week, so that could cause the markets to move quite a bit on Wednesday. Now, like I said, I've got over 20 years of trading experience in the stock market, and what I am seeing right now with the Fed raising interest rates is this is not like a lot of the other times where the Fed raised interest rates. Most of the other times it was because the economy was getting stronger and the Fed felt like they could raise interest rates because they didn't have to stimulate and boost the economy anymore. This is a very different situation that we're in right now. The Fed is forced to raise interest rates right now because inflation is so high. And keep in mind that the last time inflation was this high was 40 years ago. You've got to go all the way back to the late 70s or early 80s to find inflation as high as it is today. And when the Fed raised interest rates back then, it didn't cause the stock market to necessarily go up in any great meaningful way. In fact, the stock market suffered quite a bit because in addition to that, we also at that time had oil prices rising due to an oil embargo. And so back in the late 70s, the inflation was as high as it is today. Oil prices were skyrocketing due to an oil embargo, and the Fed had to raise interest rates to keep inflation down. That in turn caused a massive recession in the economy. And as we've seen from history, 100% of the time when the Fed raises interest rates, it causes a recession. Always, going all the way back to 1950, every single time the Fed raises interest rates, it causes a recession. So it's not a matter of if we'll get a recession, it's a matter of when. And the other thing I want to point out is, in today's time period, we have both the inflation sky high, the highest it's been in 40 years. We have oil prices rising due to a world event, which I'm going to talk about in a minute. And so those two things combined, and then you tack on the Fed starting to raise interest rates, it is shaping up to be another period just like it was in the late 70s when all of this occurred, the exact same scenarios, and at that time the stock market really suffered. And it took a while, but the stock market really suffered. So keep that in mind that yes, in that period of the early 80s, the stock market did go up. But in the period of late 70s, when they had those rising inflation, the same we have right now, they had oil prices going up, and they had the Fed raising interest rates during that period, which I think is a lot closer to what we're in right now than we were towards the tail end of it in say, 82. But if we go to the late 70s period, where inflation was rising, which is what we're in right now, that period was not good for the stock market. The stock market went down, and the economy entered a pretty bad recession during that time period. And so I think that's what we're actually set up for right now, is we're set up for the stock market going down and the economy entering recession. So that is what I'm kind of planning on and pricing in right now. Goldman Sachs says that if we do actually enter a recession, which I think we will, they think that the stock market overall, at least the S&P, could fall 24% from highs this year. So if we do in a recession, which I think we will, then we could see the S&P fall 24% from highs. That's what Goldman Sachs is predicting right now. Now, even Goldman Sachs said even if we don't enter a recession this year, let's say the recession comes next year, then the stock market will still fall 12% from highs. That's what Goldman Sachs is predicting. So either way, Goldman Sachs is saying the stock market's going to keep going down from here. That's what I've been saying, and a lot of other people have been saying as well. So just be prepared for it. This is not a correction. This is an actual bear market. We will keep going down from here. This is not the bottom. Okay, now let's talk about the Russia-Ukraine conflict. The White House said Russia made a dramatic increase in the number of troops at the border of Ukraine over the weekend. That is the same sudden buildup that we saw just before Russia invaded Crimea. So governments across the world are worried that Russia might invade Ukraine this week. Now, it is unlikely that the United States will intervene outside of some sanctions and sending the minimum number of troops required under NATO agreements. We have a president who is very anti-war right now, as evidenced by the sudden exit out of Afghanistan. And sanctions won't really do anything because the United States doesn't really have any economic power over Russia. But a Russia-Ukraine war could have other consequences. One of the biggest consequences right now is that China might support Russia, which in turn could deteriorate China-US relations. And that could cause problems for US companies that operate in China, as well as cause US listed Chinese stocks to drop. That could be bad news for stocks such as Tesla, NIO, and Alibaba. Now, another concern arising out of the Russia-Ukraine conflict is the price of oil. If Russia invades Ukraine and Europe imposes sanctions on Russia, Russia could retaliate by cutting off the supply of oil and gas to Europe. Russia has already threatened this, and the concern is causing the price of oil to skyrocket. That's because if Russia limits the supply of oil, prices will go up to meet demand. Most people think oil will top $100 a barrel if Russia invades Ukraine. Oil prices actually rose 1% over the weekend to just under $95 a barrel. That could be good for oil and energy ETFs such as USO and XLE. Just keep in mind that if Russia does not invade Ukraine and instead backs down, that could cause oil prices to tank. And a lot of people think Russia won't actually invade Ukraine, that this is all a political ploy to get Western nations to agree not to add Ukraine to NATO. So investing in oil and energy, especially now, carries a significant amount of risk. I personally think it's too late to invest in oil and energy ETFs. If you invest now, just know that it is not guaranteed that you will make money. In fact, I personally think it's far more likely that oil and gas and energy ETFs are going to come down over the next few weeks than go up. Russia does not want to invade Ukraine. That's not what they want. All they want is for Western nations to guarantee that Ukraine will not join NATO. If they get that, they're going to back down. It's all over. There's no war. And oil, gas, and energy prices are going to come down significantly. Okay, now let's talk about the earnings coming up for this week, and there's a few notable companies that we need to talk about. The first is going to be Tuesday after the close. We have Roblox reporting. I know a lot of retail investors are invested in Roblox. We also have Upstart and Airbnb. You know, one thing about Upstart that you need to understand is, yes, they do provide loans. However, they are still technically a fintech company. So just keep in mind that even though they do provide loans and they will benefit from rising interest rates, that they are still a fintech company, so they might still fall after earnings. And of course, we also have Airbnb reporting Tuesday after the close, and Airbnb has traded pretty flat since its IPO, but they did just turn a profit last quarter, so it's going to be really important to see if Airbnb can turn another profit this quarter. Then Wednesday before the open, we have Shopify and the Trade Desk, and then after the close on Wednesday, we have Nvidia and Marathon Oil. Just keep in mind on Marathon Oil that the rising oil prices that we've seen over the past few weeks are not going to be reflected in their last quarter numbers. So don't expect a major rise in price on that one unless they give really good guidance. Now, a really big one for retail investors Thursday before the open is going to be Palantir. Palantir, we're going to be looking to see if they could expand more globally beyond the United States. We're also going to be looking to see if they have expanded their commercial sales and gone a little bit more beyond their government contracts. Now, the one thing about Palantir is if they did pick up a lot of new clients, that is going to be bad for earnings because that means they would have spent a lot of money trying to acquire those clients. Keep in mind that Palantir has a very high upfront client acquisition cost, and they don't really break even on those clients for many years after they acquire them. Now, after the close on Thursday, we have Roku and Dropbox reporting, and then another big one for retail investors is going to be Friday before the open, which is DraftKings. DraftKings has been absolutely beat up over the past few months, but if they can report good earnings, we could see a nice rebound on the stock. Okay, with consensus that the markets are pretty much going to continue to drop for at least the next 3 to 6 months, with some banks predicting that the markets will drop another 5 to 20% from here, a lot of people are moving their money into cash right now and just holding cash on the sidelines, waiting to buy the dip later this year. Meet Kevin's probably the most famous person who did that, where he literally just has $20 million, pretty much his entire portfolio, in cash right now, waiting to buy the dip at the end of this year. Now, in the meantime, if you don't have a lot of experience in the market and you want to learn, I have a coaching program where I can help you learn how to trade. I can teach you about technical analysis, fundamental analysis, options, all the things you've ever wanted to learn for just 20 bucks a month. And in fact, Spartacus says, thanks, I am learning tons from SC. SC just opened my eyes to a whole new chapter of the stock market. Best $20 a month I have ever spent. Remember, the best investment that you can make is in yourself. A lot of people have told me I should be charging way more than $20 a month for the coaching, but like I've said before, I'm not here to get rich off of you guys. I'm just trying to cover my bills and take care of my family and my new baby and get some diapers and things like that. And so I'm just charging just enough to cover the bills so that I can take care of my family while I focus my time, effort, and energy on helping you as much as possible. So that's why it's just 20 bucks a month. I'm just here to help you guys out. So if you're interested in that, you want to learn how to make money, if you're tired of losing money, you want to learn options or something like that, just go ahead and join the coaching program. As most people have said, it's the best $20 you'll ever spend. Now, if you're interested in investing and you don't have a broker yet to buy stocks with, then I do recommend Webull. Webull has a promotion going on right now where when you sign up using my link in the description below and deposit just $1, Webull's going to send you 3 free stocks worth up to $3,300. They're also going to give you $5 in free crypto when you make your first crypto trade. Now, if you're not a US resident or if you're looking to trade OTC penny stocks, then I recommend Interactive Brokers. Interactive Brokers is a highly discounted trading platform. Trades start at just $1 US, $1 Canadian dollar, 4 euros, or 6 Australian dollars, depending upon where you live. And both Webull and Interactive Brokers both offer the full pre-market and after-hours trading from 4 a.m. until 8 p.m. Eastern Time. Now, I do want to remind you that I have material connections with both of those, so whenever you sign up for either one, not only are you getting a great broker to trade with, you're also helping me to continue to produce these great videos for you. Now, finally, I want to remind you to hit that like button, subscribe, and click the bell icon so that you can get notified when I release my next video. I hope you have a lot of success trading, and I will see you tomorrow.